Good morning, everybody. Welcome back to Strongman Personal Finance. In full disclosure, this is a paid video where I'm going to review the financial statements of Pacific West or Western Bank Corp. And I'm going to tell you if this stock's going to 10x or go to the truck stop. Just kidding. But anyway, if you want a paid video for any topic, click that link, send me $50, and I'll make a dedicated video. So let's go ahead and dive into the topic. Is this bank going to survive? Well, let me tell you, I have no idea. I'm just going to look at the financial statements and give you my thoughts. So Pacific PacWest Bank Corp is one of those smaller banks, not one of the big daddies. It's one of the smaller banks that got absolutely wrecked during the most recent banking crisis that we had. Now, what causes banking crises? Very simply, fear, okay? When people get scared, they run to the bank to get all their money out. And because banks don't just have a hoard of cash sitting around, guess what they have to do? They have to eventually, they have to eventually sell stuff or take on more debt to get enough cash to meet all the depositors' withdrawal requests. And what happens is if banks are sitting on unrealized losses, which mean losses that they haven't realized or sold, and they're forced to sell, they could book massive losses on their income statement, which flows to their balance sheet, and it could wipe out a company's equity. Because you can have massive losses, like you can make an investment as a bank, or you could give out loans, and you could lose massive amounts of money through inflation or interest rates, et cetera, et cetera. But those losses won't necessarily hit your income statement. But when you sell those loans, you divest of those loans, guess what? All those losses will hit your income statement. And those unrealized losses quickly become realized losses. And then people realize, wow, this bank is highly levered. It's got a very high debt to equity ratio, which banks do. They basically have a lot of debt, not a lot of equity. And when you have a huge loss, the equity gets entirely wiped out. So there are a bunch of bank runs. People, SVP went under. What else went under? Silicon Valley Bank. A couple of banks went under, right? And people are concerned that PacWest is another bank. Now, you look at the stock price, right? Before the massive sell-off, before the crisis, it was trading at $27, $28. Okay, pretty respectable. And now it's $7.11. So people are looking and they're saying, is there an opportunity here? Because look, it went down so massively. And obviously it's going to come back up. Well, remember what happened with, I'm drawing a blank here, First Republic, okay? That stock went down massively, and there was a chance that company could have survived, 100%. But it went ahead and died, basically, and then it was bought out by JP Morgan, I believe. But when you're playing in this arena, it's basically feast or famine. Like, I don't have the balls to play in this area. I tried to gamble on this stuff. I couldn't do it. I bought a First Republic Bank, and then I sold it within a day or two. I couldn't handle the stress because these things can quickly just wipe out the shareholders. So when you're playing in here, this is gamble. You should not put your whole portfolio. I wouldn't put any part of my portfolio personally, or if I did, it'd be a very immaterial amount. This is more of like a gambling chip. Like, oh, maybe I want to go on vacation and maybe I want to stay at a slightly nicer hotel. So I'll put $300 in here and see if it doubles or something. Maybe that's what you should do, but you should not be going balls to the wall, putting all your money into Pacific West Bank Corp, because these banks can easily collapse. Banks are very fragile. Okay. I don't like banks. They're scary. They scare me. Okay. But banks can go under in a heartbeat. This thing can crash from 7 to 0 in the blink of an eye. So let's go ahead and read some news about this company. So the first thing that I noticed, so there's all this drama around this bank, right? And then they announced quarterly dividends. Let's read. PacWest Bank Corp declared a quarterly cash dividend of 1 cent per common share. What? Just stop. Why are you paying a dividend? Well, I don't understand. It's 1 cent per share. Just don't pay a freaking. Well, some retail investors might think that if we still pay a dividend, that means the bank is solid. If you're worried about cash leaving your business, which will destroy a bank because it forces you to sell unrealized losses and realize them, Why are you spending any amount of money on dividends? 1 cent isn't going to change anybody. Is this like a Chad statement? Oh, I can pay we can still pay a 1 cent dividend per share. Look at us. Oh. That's stupid. Okay. But they're paying a dividend. It's passive income. Blah, 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 blah. Okay, so they're paying a dividend. That's great. Oh, you should buy it for the passive income, bro. Joseph Carlson. And then they issued a bank update on May 4th, 2023. In light of recent reporting strategic actions, Pacific PacWest provided the following update. As previously announced, the company has explored strategic asset sales, including moving the 2.7 million lender finance loan portfolio to held for sale in 2023, Q1 of 2023. This planned sale remains on track, and upon completion, will accelerate our CET1 capital ratio, whatever that means. Here, look, it's very simple to understand, okay? You can have unrealized losses that don't show up in your income statement, but when you sell your portfolio, they become realized losses, and those losses will reduce your equity. So banks can look like they have positive equity, but in reality, they could be sitting on massive unrealized losses. And normally that may not necessarily be a big deal, right? Because let's say a bank has a bunch of mortgage loans they've originated, and they're sitting on the books, and they're collecting interest and principal payments from the people that they lent money to. Well, when interest rates go up, the prices of bonds, loans, et cetera, any kind of asset that has a fixed rate or any kind of receivable that has a fixed rate, the value of that's going to go down because the cash flows are being discounted at a higher rate. So if you don't have to sell it, it doesn't really matter, right? Because you're just still collecting the interest, and as long as you don't sell it, you don't have a realized loss. But when you have to sell a loan, yeah, if the interest rates have gone up, the loan value's down. And when you sell it, that unrealized loss hits your income statement, your balance sheet, and wipes out your equity. Okay, so it looks like they're selling a huge part of their portfolio. I can't wait to look at the financial statements of this company, this bank. Core customer deposits have increased, with total deposits totaling $28 billion as of May 2nd, with insured deposits totaling 75%. Okay, so it's a slightly different profile than SVP. I keep mixing up these banks. Okay, and then this is an update from a couple months ago. But they were basically just updating people. Obviously, like it's old news. So let's go ahead and dive straight into the most recent quarterly report. Okay, this report period ended March 31st, 2023. So let's just go straight to the balance sheet, man. Whatever. Oh, what are the risks? Oh, I could go completely bankrupt. Okay. What are their assets? Cash and interest earning deposits in financial institutions. This is basically their liquid capital. So as of March 31st, 2020, what did I just do here? What did I just do to this? Hold on, let me refresh this. Okay. I freaked out the report. I'm sorry. Unsubscribe. Okay, I won't click on the screen again. So total cash equivalents, $6.6 billion. Let's look at their deposits. Total deposits, $28 billion. I've actually seen worse ratios. Okay, they're actually like from the cash on hand versus their deposits, it isn't as bad as other companies that I've seen. Let's see, 668 136 divided by 28 187. Yes, just based on like a surface level, they're holding like 23% cash reserves, which is pretty crazy. Okay, and they were and that makes sense because they're worried. They're borrowing money. They're worried. They're going to go completely bust. I mean, look at the prior year. Look at the reserves. They had 2.2 billion versus 33 billion of deposits. So they're sitting on way more cash to try to weather the storm, and yet they're still paying a dividend. So let's go look at some of the other items on the balance sheet. Securities available for sale. When you see available for sale, okay? When you see available for sale, what that means is the profit and loss. If those securities lose money or gain money, those losses don't go to the income statement. They go to the statement of comprehensive income, okay? Let me show you. We're going to go there real quick. So available for sale, at fair value. So this is the fair value, right? This is the fair value, the market value of the portfolio as of March 31st, 2023. Look at the amortized cost of the portfolio. This is basically what they paid for it in a simple sense. It's down. The fair value is down. They've booked huge losses on this portfolio because of interest rates. Interest rates go up, bond prices go down, loan prices go down, whatever. Let's go look at the income statement. Where is it? Where's the loss? Oh, well, if we go down, we could see unrealized net holding gains or losses on securities available for sale arising during the period. So, and it works both ways. In the most recent 3 months, they actually had some gains on these portfolios, but they've booked massive losses. Look at the prior year. Look at the unrealized net holding gains or losses on securities available for sale arising during the period. $609 million of losses. Unrealized, which means you haven't sold it yet, but the value of that portfolio has gone down, but it didn't go to the income statement. It goes here, which is below the income statement. And then from here, it goes all the way to the balance sheet under the accumulated other comprehensive loss right here. Okay. So that's kind of how it flows. But if you're just looking at the income statement, look, they're making a big profit. Well, in reality, look at last year. If you actually consider everything that is realized and unrealized, they had a massive loss in 2022. They had a comprehensive loss of $322 million. But if you're looking at the income statement, they had $120 million of profit. Earnings per share of 1.01. Oh, wow, EPS is good. So it's not a big deal necessarily unless you have to sell it, okay? So, but that's something to keep in mind, okay? So available for sale, let's see, securities held to maturity. So it looks like this is the loan balance that they're moving from held to maturity to held for sale. So basically, it looks like they're going to sell this portfolio right here. Let's go back and double check that. Where did I see that? Including moving the 2.7 lender finance loan portfolio to held for sale in Q1. So we go back. Let's see. Loans held for sale. Okay, hold on a minute. Okay, so here's loans that they're going to sell right here. So this sale right here, when they sell that, they're probably going to book a loss, okay? Honestly, they're probably going to book a pretty significant loss. When a loan is held for sale, basically they're saying we're about to sell this. Now, if you look, let's say they wanted to sell these securities held to maturity at amortized cost, right? The fair value of these securities, investments, whatever, is $2.15 billion. But on the balance sheet, it's carried at amortized cost, okay? 2.273. So there is a loss sitting on this portfolio of held to maturity securities. Now, like I said, if they don't sell it, it doesn't go anywhere. Available for sale goes to comprehensive income. Held to maturity doesn't go anywhere. It just sits on the books, and it's recorded at amortized cost. You have to understand like the basics of accounting. That's why I say you have to understand accounting, like the basics. Because if you don't understand this stuff, you don't know what you're looking at, okay? And I'm not even saying I'm a genius at it, but it's like, holy crap, man. So if they were to sell this entire portfolio right now, they would book $120 million of loss right now. Now, this portfolio, I don't know how many losses they're sitting on here, but when they sell that, I guarantee you they're going to book some kind of loss. It ain't going to be pretty in the most recent financial statements, okay? So, let's see. So, they're sitting on a lot of cash. They still have a $2.2 billion portfolio that they could dip into to sell there. Federal Home Total Investment Securities, loans held for sale. Let's see. Gross loans held for investment. Okay, they have even more loans here. Okay, look at this. Oh my God. This is actually like a confusing balance sheet, how they have everything structured here. But they have a ton of loans. Now, if they have to sell this too, I guarantee you these are also sitting at a massive loss. All right, deferred fees, allowances. Let's see. Try to see if there's anything else crazy on here. Goodwill. Oh, look at this. 1.3 of goodwill. So goodwill is when you acquire a company for more than the fair value of its net assets. When you impair a goodwill, it goes from your balance sheet and it hits your income statement because you're crediting the asset, you're debiting a loss account, basically. Your goodwill, if you impair that goodwill, you get a massive loss. So this company probably has a massive loss on their income statement because they impaired the goodwill. And they were acquiring a lot of companies. Holy crap, man. Okay, goodwill went down, other assets. Okay, so that's kind of, you have to understand like what a company's portfolio is, okay? And you have to understand what you're looking at and where the profit and loss goes. All right, let's look at liabilities. So obviously we know deposits have gone down. People are pulling their money out. Borrowings have gone massively up. So now instead of paying a little bit of interest, they're probably paying way more interest on the borrowings from people. But so, okay, deposits are down massively. Borrowings are up. Debt hasn't really changed. Subordinated debt hasn't really changed. And accrued interest payable has actually gone down a little bit. So overall, it's a little concerning. That's all I'm going to say. Okay. If people keep pulling money out of this bank and they have to keep selling that portfolio, that's more and more and more losses that they're going to have to book. Now, their total equity is $2.7 billion. So if they had to sell a significant chunk of their loan portfolio, that would be annihilated. Okay. And they're sitting on a huge accumulated other comprehensive loss, which is a massive weight on their equity. Okay. That's from the available for sale securities. But you don't see the held to maturity losses. You don't see it on here. This held to maturity portfolio, you don't see the losses. You don't see them in equity. So you could have massive losses, and if these get sold, it wipes out the equity. So something to keep in mind, okay? It's a gamble. It's a gamble. You can make money, but cool. All right, let's look at income. So, okay, they have way more interest income coming in. That's great. Interest income is up. Interest expense is also up because they're paying more in deposits. Borrowing expense is massively up because they're borrowing money to stay alive. And they're paying more on their subordinated debt. Their net interest income has actually gone down. That's interesting. So even though they're generating way more interest income, after all the interest expense they have to pay because they make money from interest and they have to pay their depositors and people they borrowed money from, their net interest income has gone down. Let's see. Non-interest income, leases, gain on securities, I was about to say dividends. Okay, dividend income. I was like, when a company pays dividends, it doesn't go on their income statement. This is dividend income. I was like, what? Okay, so their non-interest income has gone up. That's great, mostly due to not losing money on investments. That's the only real difference there. Companies that they've bought but don't fully own. Non-interest expenses. I'm trying to see if anything jumps out at me. Insurance and assessments. Oh, here's the goodwill impairment. You see how the goodwill leaves your balance sheet and it goes to your income statement? They had a $1.3 billion goodwill impairment, which made them have an insane, massive, mind-blowing, horrible loss. Okay, but that specific event won't repeat because they don't have goodwill anymore. They wrote down whatever company they acquired, they wrote down all of it. It was just a massive write-down, basically. So overall, without that goodwill impairment, they actually would have had a little profit. That's cute. But that's not the concern. The concern is people are going to rush, take their money out. They're going to have to sell their portfolios at realize a loss. And then the bank collapses because the equity gets wiped out. And then you as the investor get absolutely destroyed. And then JP Morgan comes in and buys it for pennies on the dollar and, comes out on top. Okay. So, yeah, there's really nothing more to say. It's a gamble. I mean, this isn't like there's differences between each one of these banks, but you got to understand what you're looking at when you're looking at the balance sheet. You got to understand how these companies' portfolios are structured and where the profit and loss goes. So just in a final review, Available for sale securities, their gains and losses go to the statement of comprehensive income, which is down here, which doesn't show up on earnings per share. You're not going to see this in earnings per share, but you can see it in equity. Okay. Then you have held to maturity. That's what you really need to pay attention to, because if they're talking about selling some of these, you need to see the losses that are built into these, because they're about to become real losses. But if these were never sold, you would never see the losses on the income statement or the statement of comprehensive income. You wouldn't see it at all. It would not be booked because they're held at amortized cost. Okay. Now, this is all confusing. That's okay. You can just buy VT. Okay. I'm too much of a bussy to invest in these things, man. I tried for like a gamble. I mean, I actually made money on First Republic. I made like $10. I just couldn't. I'm glad I sold, because I had mussy hands. I couldn't hold on to these things. It's a gamble. That's all it is. Okay. So there's really nothing more I could say. I mean, I could look at, let's look at the cash flows over time. It doesn't matter when it comes to this. It's sink or swim. Sink or mother effing swim. I mean, we could look at management's discussion and analysis. Management discussion and analysis. Anything special on here? La 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 la. La 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 la. Let's see. Blah 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 blah. Impact of 2 bank closures. Impact of first. Okay, they're just covering the news. Really? Some banks went under. I didn't know that. First Republic sold to JP Morgan. See, the big banks always win, man. They always win. They always win. Let's see. I want to see their I want to see more details on their held to maturity portfolio. Let's see if we can find that real quick. That's what I'm really interested in. Held to maturity. Okay, so mature. This is what you really need to pay attention to. No. Let's see. Okay, here we go. Investment securities available for sale. So these are all investments that they've made that are classified as available for sale. And you can see the gross unrealized losses. Okay, so they paid this much for it. This is how much they paid for all these different investments. These are the unrealized losses, which means they haven't sold them, but they still hit the statement of comprehensive income. And then you have the fair value, what the value is, the market value of these securities. So you can see there's like agencies, there's treasuries, it looks like it's mostly like higher quality stuff, right? I got some corporate debt, but the issue is even treasuries can go down in value, because when interest rates go up, fixed income asset prices go down. That's just how it works. Okay. So this is actually very interesting to look at. And then let's look at available for sale. Where's the held to maturity? Come on. Oh, we're going to show you the thing that's we can see on the income statement already. Okay. Securities held for maturity. Allowance for credit losses, gross unrealized gains. Okay. So here is some of their investments as of March 31st, 2023. Municipal securities, agencies, private label. So basically what they're saying is when these are held to maturity, they're saying we're going to buy these and we're not going to sell them. We're just going to wait until the bond or whatever it is expires or gets redeemed, basically. So what they're saying is they have no intention to sell them, but they can still be sold. Like you can go and buy a 10-year treasury, a 10-year government bond, and you can just collect the interest every single year. And then at the end of the 10th year, you get the initial principal back. You taking notes, by the way, Paul Gabriel? You get the initial principal back. And you don't really lose money except opportunity cost. But if you sold that when interest rates went up, you would have a realized loss because the market value would go down based on market conditions. So you can see this held to maturity portfolio is sitting on gross unrealized losses of $117 million. So if they sold these right now, they would lose $117 million because the fair value is this 2.157 versus the carrying amount of 2.273. All right, that's December 2022. Credit losses, quality indicator. Interesting. So they have mostly like higher quality, basically all higher quality debt. Mostly AAA. Okay. But even AAA bonds, people think bonds are safe. They're not. Okay. They have specific risk. Even if there's no credit risk, there's still like interest rate risk. That's always for every single debt security. There's interest rate risk. 100%. Just buy bonds, bro. They're safe. I guess if they're held to maturity. Let's see. Yeah, these are mostly they mostly have longer term debt. They're probably yield chasing. Clowns. Oh, how do we get higher interest? Let's buy long-term debt during historically low interest rates. Okay. Loans and leases. Okay, loans and leases held for sale, held for investment, excuse me. Let's see. Okay, they don't show the fair value of these. Current total. I'm trying to see if they actually show like unrealized losses in this portfolio, because this is where a lot of their money, their investments are. Look at this. They have $25 million in real estate. They have mortgages outstanding. They have real estate loans. They have commercial loans. They have consumer loans. This is their main loan portfolio, it looks like. But it's held for investment. So if there's losses, which I guarantee you there are losses because interest rates have gone up, you're not going to see it. So it's a little annoying they don't show. That's what I would be worried about. That's something, if they don't show you here, then how do you know? If they are forced to sell these, they're going to get wrecked. Okay, non-accrual performing. Let's see. Non-accrual loans. I mean, maybe it's somewhere in here. I'm just not seeing it. Maybe I'm blind. But I'm not seeing unrealized losses on this portfolio. I mean, and like technically, if they're holding it to maturity, they don't have to show that, but it's good to know. So overall, there could be hidden losses in here that if they had to divest this portfolio, they would probably realize losses, but it's not showing me. So I can't really tell you how many losses they're sitting on. But I don't know. It's a gamble, man. It's a gamble. Good luck. All right, let's see. And if you want a paid video, analyze. I'm a bank expert now. Accounting's so boring. If you want a personalized video, you send me $50 and I'll make you a video. Strong my dong. Why do central banks around the world collect a lot of shiny rocks? That is a good question. I don't understand that. I wish I could call Jerome Powell and be like, dude, why are you buying shiny rocks? Can you explain this to me? It's a shiny rock, Jerome. You'd be like, oh, you're right, strong man. We're selling all our gold tomorrow. Hello, Strongman. I bought NCL Cruise Line for good luck to you, young man. I hope you succeed. Strongman Personal Finance. After watching for 2 years, I think I should go all in. Anything Lefebvre recommends. What do you think? Yes, you should listen to Jeremy Lefebvre. Put all your money in stocks that are going up a lot that he's pumping on his channel. Ultra testosterone. Bro, these banks don't keep the deposits since they can't match interest rates. Yeah, people are fickle, man. I mean, when it comes to me, like I've got my bank, right? I have USAA, and they just did not pay me interest. I was like, this is stupid. Why are you paying me 0.05% interest, you scamming degenerates? And eventually I moved like $16,000 out of USAA and I put it into Vanguard, into like a treasury money market fund, which is paying me like 4 or 5% annual. So it's like, yeah, I don't blame people for moving their money around. Let's see. Now it's 1440. Oh, you made some money. Good job. When you making Bob a video, or are you too scared because the stock went down versus I need to get through my paid videos. Okay, trust me, I want to talk about Palantir, Nvidia, and all these other clown stocks. Trust me. Okay, I'm almost done with these videos, and then I'm gonna get back to what I want to do. Should I sell? That's a personal choice, man. I can't give you a sell recommendation or you'll sue me. Mark to maturity for bonds too. They all have trillions of long-term bonds at low interest rates. Yeah, yeah. If they have to divest those portfolios, if you buy long-term debt during very low interest rate environments, you're a clown. Okay, you're like, interest rates have never been lower. And you're like, oh, I'm going to buy the longest term debt I possibly can. So when interest rates go up, my losses, my unrealized losses are massive. And then if I'm forced to sell this portfolio because customers are pulling out their deposits, I have to book real losses. And then those losses absolutely annihilate my company's equity. But whatever. No, I'm just an accountant. Did Michael Burry buy this recently for his fun? I don't know. Did he? I don't care. It's a gamble. No one going to pay Strongman for a tattooed chef mukbang. Come on, Matthew. $50. And I got to buy the tattooed chef, too. Who's this ultra testosterone? I'm amazed people are too lazy and willing to pay you to do the research instead of doing it themselves. I need to start my own channel and charge $100. Your price is too low, Strongman. Maybe. It could be, but I don't want to charge an insane amount of money because I'm still getting ad revenue from making these videos. He's entertaining. Person waiting to DD at his local coin shop. NVIDIA. NVIDIA is all the rage. You see, if I wanted to get a lot of YouTube views, it's so easy to be a scammer. You talk about cult stocks, and when a stock goes up, you talk about how it's going to keep going up. It's as simple as that, okay? Oh, NVIDIA's going to the moon. Oh, will it keep going higher? Yeah, you should buy NVIDIA, bro. Yeah, it's a good deal. 1 month T-bill at 6. Whoa, man, I got all this cash. Basically all my savings are in a treasury or like federal money market fund at Vanguard. I'm getting like nice interest deposits, like 60, 70 bucks a month. I'm like, oh, baby. It's nice. I like it. I like these high rates. I can buy stocks in the cheap and I get interest deposits, nice interest deposits. Let's see. Vanguard, but yeah, they're doing pretty well. I mean, obviously, you know, the money markets aren't FDIC insured usually, or I think all of them aren't. So that's something to consider. But the way I think about it is like, it's a federal money market fund. Okay. It's like all federal short-term debt, repos, all that stuff. Why would I be worried about it? If I trust FDIC, which is a federal program, basically, why would I be worried about putting my money into a federal treasury money market fund? But whatever. You do what you want. Strawman, I will show you silver will win. I will show you, boy. Your butt is mine. Hey, you want my butt? It costs you $50. Why would bankers care that they were totally incompetent in buying long-term bonds at low rates? They walk away with millions as the banks collapse. That's true. I don't know what to say to that, man. Correct. If money markets collapse in FDIC, exactly. That's why I don't worry about it. It's like, okay. Oh, but it's not FDIC insured. Oh. Okay, it's federal. Whatever. Vanguard money markets are as safe as FDIC. Well, I'm not going to say whether that's true or not because that's everybody's own individual decision. But I have my money. I have my emergency savings in a federal money market fund. Maybe I'm an idiot. I don't know. All right, that's it. Talk to you later. If you want a video, send me money and I'll make one. Cheers.